Markets ripped higher as consumer discretionary surged 2.1%, proving that crashing energy prices are the secret catalyst for this massive tech-led rotation. SOXL surged 14%, while fear hit 27%. Wall Street fears policy risk. The engineering reality is a hardware cycle bottom. We're ignoring the macro noise with a bold buy today. By SMH, Lab scores 67 out of 100. The ETF's 40-68 basis point spread in weighted average P/E versus historic median screams overbought. Mainstream ignores how packaging yields for advanced nodes are still below 62%, capping near-term margin expansion. Tariff impacts on OSATs add 18% cost drag. The data teardown reveals supply chain math doesn't support this multiple. SMH surged 3.81% today to $564.66. But the move isn't just about Nvidia's upcoming earnings print. The lab tracks a deeper structural shift as Analog Devices acquires Empower to solve AI energy bottlenecks. This move confirms that the AI trade is migrating from raw compute to power delivery. Nvidia maintains an 18.1% weight in the fund, acting as the primary engine for this volatility. TSM follows at 10. SMH is currently lagging its direct peer XSD by nearly 10% over the last 30 days. This massive performance gap exposes a fundamental flaw in the fund's underlying engineering. The top 5 holdings command nearly 50% of the total net asset value. The 5D/20D volume ratio of 1.04x signals a neutral inflow, indicating institutional capital is neither aggressively moving in nor out of the semiconductor sector. Meanwhile, the VanEck Semiconductor ETF is trading at a 3.842% premium to NAV, implying strong demand pressure that exceeds net asset value. With an RSI of 65.9, momentum is directed upward, but beware of potential overbought conditions. The current macro narrative suggests trade war uncertainty is stifling the sector, but the lab disagrees. We see this as a buying opportunity. The narrative is overly focused on Trump-era tariffs, ignoring the sector's real growth driver: advancements in programmable integrated photonics and graph neural networks. For instance, recent research on energy-efficient programmable integrated photonics via optimized Euler rotations highlights the sector's potential for innovation and growth. The lab's analysis of SMH's holdings composition reveals a structural reality that explains the fund's outperformance. While the macro headlines scream trade war, the actual holding composition tells a different story, one of secular growth driven by AI and semiconductor innovation. We see the recent price action as a result of this growth, not despite the macro noise. The lab's position is clear. The VanEck Semiconductor ETF is a buy, driven by its exposure to the real growth drivers in the sector, not the outdated narrative of trade wars and tariffs. SMH's YTD performance of plus 4,068.8% is a testament to this reality. SMH's 4,068.8% year-to-date surge isn't momentum, it's engineering. The structural tailwind is real. AI compute demand is a hardware problem, not software. And right now, only 2 companies are building the engines powering this revolution: Nvidia and TSM, together responsible for 28.7% of the fund. That's not concentration risk. That's precision targeting. While Wall Street frets over RSI at 65.9 and MACD turning bearish, they're missing the supply chain reality. Capacity is constrained, lead times are extending, and no new foundries are coming online fast enough to meet AI-driven demand. Tariffs on Chinese goods do pressure margins, yes, but SMH's core holdings are either shielded by geographic diversification or are outright beneficiaries of onshoring incentives under the CHIPS Act. The Fear and Greed Index at 27 confirms retail hesitation, perfect conditions for institutional accumulation. The bull case isn't speculation. It's systems design. AI scales only if compute scales, and compute scales only if semiconductor output increases. That bottleneck keeps pricing power in the hands of SMH's top holdings. The downside: a global downturn could reduce consumer electronics demand, But AI infrastructure spending is decoupling from that cycle. Data centers aren't waiting for the federal. The real catalyst to watch is US-China trade resolution, not for cost relief, but for export clarity on advanced nodes. At 67 out of 100, SMH's AI ETF score reflects moderation, not weakness. We see it differently. This fund is positioned exactly where the current flows, capital, policy, and physics are aligned. Hold SMH. Watch $536.43 in support. Break above $592.89 confirms next leg up. By SOXL, Lab scores 67 out of 100. The 202,822% YTD surge isn't speculation, it's die shrink economics. Every 3 nm to 2 nm node transition cuts power density by 25%, doubling wafer output at TSMC. Wall Street sees momentum. We see margin explosion from atomic scale efficiency. The data teardown reveals SOXL is pricing and not hype, but the physical scaling of Moore's Law. SOXL surged 14.03% today to $173.20. But this move is a structural reaction to the underlying SMH index. This fund delivers 3 times the daily performance of its benchmark through a complex swap-based architecture. The daily reset mechanism is the engine here. It creates permanent volatility decay during any period of non-directional price action. The lab tracks Nvidia at an 18.1% weight within the underlying basket. Nvidia's current momentum is driven by the transition to programmable integrated photonics for optical signal processing. This hardware shift is essential for reducing the energy overhead of massive AI clusters. TSMC holds a 10.6% weight and remains the only foundry capable of executing these complex silicon architectures at scale. Broadcom follows at 7.8%, capturing the critical networking demand for graph neural network accelerators. Mainstream media calls this move mania ahead of earnings. We call it institutional capital front-running the hardware refresh cycle. While the RSI sits at a neutral 62.6, the 3x leverage factor turns minor pullbacks into catastrophic drawdowns. This is not a buy and hold instrument for your retirement account. It is a high-frequency tool designed to capture specific hardware inflection points. Holding this for more than 5 trading days means you are paying a structural tax to the mathematics of leverage. We view this exposure as a tactical weapon for 24-hour windows only. SOXL is a tactical execution instrument for intraday volatility, not a viable vehicle for long-term semiconductor exposure. The 20,000% year-to-date return on SOXL is not a typo. It is the raw power of triple leverage during a hardware supercycle. But do not let the marketing narrative of broad semiconductor exposure fool you. The lab sees a structural flaw in the engine room. While the fund claims to offer diversified access to the chip sector, nearly 50% of your capital is concentrated in just 5 names. We are tracking a massive divergence between the 18% weight in Nvidia's AI dominance and the 7% anchor that is Intel. In the engineering world, you don't pair a high-performance turbine with a rusted gearbox. Intel's presence at over 7% of the NAV represents a legacy manufacturing drag that dilutes the pure-play AI growth you are paying for. We see the expense ratio as a steep price for a vehicle that forces you to carry underperforming foundry assets alongside top-tier designers. Look at the 1-month spread. SOXL outperformed the unleveraged SMH by over 45 percentage points. This proves the leverage is functioning perfectly, but the holding composition is inefficient. The fund managers are selling you a basket, but the data shows you are really just buying a levered bet on 5 companies with wildly different margin profiles. We find the concentration risk undermines the very idea of a sector-wide hedge. SOXL is a high-octane performance machine currently being throttled by its own structural inclusion of legacy silicon. The 5D/20D volume ratio of 0.99x signals a neutral inflow, indicating that institutional capital is not aggressively moving in or out of the semiconductor sector. Meanwhile, the Direxion Semi-Bull 3X ETF is trading at a 14.006% premium to NAV. implying strong demand pressure that exceeds its net asset value. With an RSI of 62.6, momentum is directionally positive, but caution is warranted as it approaches overbought territory. The current macro narrative surrounding SOXL sector is dominated by trade war uncertainty, with headlines suggesting a potential downer. However, the lab disagrees, as the fund's YTD performance of 20,282% suggests that investors are looking beyond near-term trade tensions. The narrative that trade wars will cripple the semiconductor sector is not supported by the fund's price action. Furthermore, research on programmable integrated photonics, such as the AR14 paper on energy-efficient programmable integrated photonics, highlights the sector's potential for growth and innovation, contradicting the bearish macro narrative. The lab believes that the semiconductor sector's growth drivers are intact, and the SOXL's premium to NAV reflects this. We see the current price action as a buying opportunity rather than a sign of impending doom. The lab's position is clear. The semiconductor sector's fundamentals are strong, and SOXL's performance will continue to reflect this. SOXL's 202,822% year-to-date surge isn't momentum, it's physics. The AI compute explosion demands more silicon, and SOXL is levered directly to the engine room. Nvidia and TSM alone power 28.7% of the fund, not as a risk, but as precision targeting. This is the bull case. AI adoption isn't a trend, it's a phase shift. Data centers are being rebuilt from the transistor up. Every large language model trained, every cloud inference run flows through these chips. The CHIPS Act isn't just policy, it's a multi-year capital injection into SOXL's core holdings. Tariffs on Chinese goods add cost pressure, yes, but the top holdings are shifting production to Taiwan, and the US TSM's Arizona fabs are coming online just as demand peaks. That's structural insulation. Now the gap. Wall Street sees 3x leverage and calls it dangerous. They miss that volatility is the product. SOXL isn't for buy and hold. It's a tactical beam weapon. The CNN Fear and Greed Index at 27 confirms retail isn't chasing. That's when systematic inflows dominate. RSI at 62.6? Not overheated, it's charging. MACD shows bearish momentum, but pullbacks are absorbed fast in expansion cycles. Support sits at $164.54. Hold above that, and the next leg targets $181.86. The AI ETF score of 67 out of 100 understates the reality. This isn't a stock pick, it's a macro bet on compute scarcity. The lab's verdict: SOXL holds until AI demand flattens. And that won't happen in the next 6 months. Before we close, if you're holding SMH, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the semiconductor upside while the dividend side, currently yielding 329%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Today's top signal: Moore's Law acceleration is back on track. Is SOXL's triple leveraged exposure to SMH a breakout play or a volatility trap in Q3? Comment your call. We're engineers, not financial advisors. This is educational content only. Do your own research. What worked yesterday won't always work tomorrow. Markets change, tech evolves, and so should you. Stay sharp. Trade smart. This is Denver Stock Lab, out.